that strength points to broadening. This rotation story a lot of investors are talking about right now, I think is very real, and it's definitely not what you see at the end of a bull market. If we were seeing a narrowing, then you can start to give a bit more credence to the top-heavy debate, but we've really seen the opposite in the last few months. So to me, that's actually a really optimistic sign for the broader bull market. So you pair that with the fact that small caps have outperformed large caps, mid caps have also outperformed large caps, and the 493 have beat Magnificent 7. Nothing suggests we are in a top-heavy market. If you're a young person trying to get into the market, let your winners run, and then don't go in and out of positions too much like I did, and I lost a lot of money by not being in those positions. If you want to let compounding do its thing, that's a very generic cliche thing to say, but it's so easy when you're getting involved in the market to get overexcited.
Welcome to The Big Skinny with Lou Basenese, where we do everything 111 and a little fun. One headline that you should think twice about because sometimes it's wrong in the consensus. One chart you should definitely pay attention to because the data seldom lies. And one investment insight you could use right away to hopefully increase your bottom line right alongside us. I'm very thrilled to have back Phil Rosen, Chief Market Strategist, ProCap Financial, and also co-founder of Opening Bell Daily News. Man, I don't know where you find the time to do two businesses at once.
This was the only thing I was looking forward to this week. It's great to be here, Lou.
Listen, man, let's jump right into it because I think there was a fresh bubble warning coming out of Michael Burry. AI is a bubble. It's about to pop. We've seen these headlines time and time again, but there's another one out from the Financial Times talking about, and you wrote about it, the idea that the only bubble out there might be in earnings expectations. Tell me about that.
Analysts have been revising all their earnings expectations for several months now. And I believe for tech sector specifically, they're up 40% for the year ahead, revised higher 40%,
right,
which is very high, maybe justified. We don't know yet. But if you look at the actual market, it's trading almost cheaper than what the forward valuations suggest or forward expectations suggest. So that to me tells me that if there's a bubble, which I don't think there is, you can only point to it on the spreadsheets, essentially, right? So analysts are very optimistic, which generally is a very good sign for markets, but markets themselves haven't even caught up to the optimism of Wall Street analysts.
Interesting. So where do you think the disconnect is, right? Because like analyst expectations are formulated based upon their conversations with management, yet they've been woefully wrong for 4 or 5 quarters, right? I mean, we've had double-digit earnings growth. Mag 7 was like 63% last quarter. Who's wrong in this equation? Or where can you point some fingers at?
That's a good question. I mean, look, when analysts at banks are covering the market, I think they have 80% buy ratings generally on their stock coverage. So you can expect them to be a bit overextended as far as sentiment, generally speaking. Right now, I do think the fundamentals have been so strong and earnings have been so good, and every single company is guiding to higher and higher earnings in the quarters and years ahead. It would be very hard as an analyst to not take that and get even more optimistic. So I don't fault the analysts in this case, but they do seem to be more optimistic than the market is maybe giving credit to right now. And I am not someone who thinks there's a bubble. I think that any comparisons to the .com at this stage are a stretch. I mean, it's really hard to find the numbers that line up with the .com era. I know people talk about, well, is it 96? Is it 98? Is it 99? I think that's all baloney. I think we are definitely
92.
And look, if you look at history, it's great to try to find the analog.
Yes.
But at the same time, I think we should look at where our feet are today, where we're seated, and take history for what it was and just understand that the fundamentals do look exceptional right now.
So do you think the stage is setting for a massive catch-up trade in valuation to catch up to these expectations? I mean, do you see how that plays out? If the analysts aren't wrong, the market's got to catch up to that at some point.
I think the market is more likely to catch up to those expectations than the analysts are to revise lower their expectations. And so that should be good news for the bulls. I think the red flag here is that if suddenly analysts or banks start to wake up a bit and say, maybe we overshot our expectations, that will probably create a more dramatic negative reaction in the market than is justified. So I think that would be a good buying opportunity, that dip. But generally, the the spreadsheets are where the bubble is right now.
That's awesome. It's not a bubble in Bubble Talk. It's a bubble in Excel spreadsheets, or maybe
So that's where we're at.
Claude coded spreadsheets at this point in time. Let's talk about the data. You have a great chart here that you wrote about recently, how the S&P 500 right now is valued even cheaper than it was at the beginning of the year. How does this happen? What does this mean? What's the history say about these situations?
So usually when a forward PE ratio comes down, it has something to do with stocks getting cheaper because their prices go down.
Yep.
But right now, earnings expectations, as we've been talking about, have accelerated so dramatically that stock prices have gone up and they're getting cheaper at the same time.
Yeah.
Very unusual. So I think right now we're hovering at about 20 times forward earnings for the S&P 500. And at the start of the year, we were maybe 22, 23. So the stock market is 10% higher than it was in January on a price basis.
Right.
And yet on a forward valuation basis, it's lower. So that to me says a couple things. The market looks attractive right now. And I think that this also pushes back completely on the bubble narrative, because how could prices be going up and valuations be going down if we are in a bubble?
Yeah. Doesn't make sense.
Doesn't make any sense. And two, I think this also makes the talk of analysts being overly optimistic all the more interesting, because if stocks are getting cheaper based on their optimistic expectations, one, you could say, okay, we're going to get some sort of re-rating in the market to catch up.
Right.
Or we'll get that buy the dip opportunity when analysts maybe get a bit slower on their expectations.
Yeah, that makes sense. It's funny because let's connect to some more data here, because we heard forever ad nauseum that tech was too much of a concentration in the S&P 500. And I could understand this pullback in valuations if interest rates on the longer end started rallying, ripping higher, because, okay, now we got to start discounting the tech names, but that's not happening. So what's the one data point? Have you come across any that starts to give you a reason to pause and go, all right, maybe the bears just are, like the broken clock, but maybe they have a point here. Maybe this is a data point worth monitoring to see if there's weakness that's going to be out there and materialize somewhere.
It's really hard to pin down the most compelling angle of the bear case right now. And I will say that's probably a blind spot of mine. And it's not that I don't look at the data. I look very hard at the data and try to figure out, okay, what genuinely makes sense from the bearish take? Why is someone like Michael Burry coming out and saying he's opening some short positions?
Got to sell some more Substacks, man.
That's probably a big part of it. But the most fascinating thing to me is that the chip sector is trading, I think, at 18 times forward earnings, which is cheaper than the S&P 500. So
Interesting.
The stocks that people are most concerned about being something bubbly is actually cheaper than the rest of the market. So if chip stocks are a bubble, which I don't think they are, then what does that mean for the S&P 500, which is actually more expensive on a forward valuation basis?
I think you were talking about before the analog to the .com days, right? What was the PE ratios? I believe, 50, 60, it peaked at like 80 plus. And here we're worried about semiconductors at 18 times and lower than the market as a whole.
It's really hard to connect the dots, I think, when you're trying to make the bear case.
Yeah.
And it's so interesting because the bull case data looks so compelling, and yet sentiment-wise, it does feel like there are more bears than bulls still. So I think the sentiment surveys continue to skew bearish. And on an anecdotal basis, a lot of the investors I speak with are taking chips off the table, or they're wondering when the top is in this part of the market cycle. I don't know. I'm not a market timer myself.
Yeah.
But it would take a lot of new data to convince me to really get out of the market at this point.
So interesting thing there, because you do talk to a lot of money managers, wealth managers, super smart people. The fact that they're trimming, generating some cash on the sidelines tells me once they go, oh crap, we pulled off, we shouldn't, and chips go back on, we can go a lot higher from here. But I also have this thought, and I want to hear your reaction to it. Why we're getting such a preponderance of bearish, like bubble top calls. We always look for asymmetric risk return potential, right? I think for the bears, there's never been a better asymmetric return possibility for them by just prognosticating, hey, this is the peak in the market. Because if they're dead wrong, if Michael Burry's dead wrong again about Palantir, no one's going to remember it because the market ripped higher. But if he's right, he gets to put on the board to go, see, I told you about the housing crisis. See, I told you about the AI crisis. Do you think that's what it is? Is more ego than really fundamentals?
If we take Burry out of it for a sec,
I don't want to make it a personal attack, but just general bearish.
Yeah. I think anecdotally among not famous investors I talk to who are bearish, I think generally they are looking more at price than earnings.
Okay.
And maybe the thing that I'm focused on is the earnings rather than the price.
Yeah.
So maybe it's as simple as are you looking at the denominator or not? That's kind of interesting. I don't really know other than why they would see the gap between earnings and price as a bearish signal right now, other than they're only focused on price. If you look at Micron and say, oh, it's up 800% in 12 months.
SanDisk, another stock that went vertical.
It's like you wouldn't expect to see a stock perform that well and then stay that high.
Yeah.
I think like historically, it's very unusual, and generally it's not a good sign to buy in at an 800% rally. So that I understand, but then when you stack the price on top of the earnings, Micron still looks extremely compelling to me. And I think the forward valuations are very cheap. It's trading at 7 or 8 times forward earnings. I don't know how to push back on that from like a bearish take other than, okay, chips are a cyclical industry. Micron is the poster child of this. Get out now. Yeah,
too good to be true after a 346% revenue print, growth print, and I don't know, it was like 1,200+% on the adjusted.
All the numbers
EBITDA.
are insane.
Yeah, it was insane. Like, all right. So you said you focus more on earnings, which I align with that. I'm simpatico there. But let's talk about the investment insight that you came with today. Is Citi? You're looking at that at price, and nothing to do with AI or chips necessarily. So this is interesting to me because financial sector, third worst performer, I think, year to date. So why Citi?
So to be clear, this was a stock that was pitched to me in our Best Ideas Club, and we publish high conviction stocks every week. And this was one recently I really liked and I thought was very compelling. As you said, financials have been not the greatest sector to bet on in recent years. And really, as a sector, you can take it all the way back to 2008.
Yeah.
That strength hasn't fully come back in many pockets of the financial sector. And I think Citi is the best example we have of a stock that has really stayed beaten down since 2008, trading about $130, $140 right now. And in 2008, right before the crash, it was, I think, at $520.
Oh, wow.
So it's come down severely and it's never come back, essentially. But their CEO is excellent and she's been driving this great turnaround story. And I do think we are at or near an inflection point where the market will start to favor this stock again. Again, I'm not a financial sector expert by any means, but I think the story is really compelling as a turnaround story, as an inflection point story, and just as a corporate restructuring and value to shareholders story right now. I personally don't own the stock. I'm very heavily considering getting into it right now at these levels, because if we can even recover halfway to its heyday,
it starts to look like an Intel, right? That was beaten down and left for dead, and then watch how fast that turned around. So I think when sentiment changes here, could be a similar potential setup.
It looks cheap right now. It looks really cheap, and it's already had, I think, a 20% gain this year.
Yeah,
and it still looks very attractive on a valuation and price perspective.
So you're looking at price. You're looking numerator and denominator here. Beaten down, out of favor sector.
Yes,
could rally into your end. I love it. Where can people find more of these ideas with Best Ideas? Before we get to a few other topics, talk to me about the Best Ideas Club.
So every morning I write a newsletter called Opening Bell Daily, and we have our our members version of that newsletter, which is called Best Ideas Club, and that comes out on Sundays. And we send a stock pick a week. And the portfolio of equal weighted stocks we've kept since last January, I believe it's more than doubled the S&P 500. So these are all, I speak with the smartest investors I can, and they give me their single best idea for the next 12 months. And then we publish the thesis to that name, add it to the equal weight portfolio, and see how performance does. And I think year to date, we're tripling the S&P 500, by the way.
Amazing,
so
man.
it's been, it's an amazing source of alpha, I think, just talking to smart people and getting their single best idea. I don't know why more people aren't doing this, but it's been pretty good for our members so far.
I'm an advocate. I'm a subscriber, so I encourage everyone else to check it out. But if you haven't noticed, we're all about all filling, zero fluff. And so is our email newsletter, where we deliver insights, one headline that you should probably ignore, one chart you should absolutely pay attention to, and one investment idea that you should follow to increase your bottom line right alongside ours. So if you're not signed up yet, go to thebigskinny.com, sign up for our newsletter. If you can't be bothered to give up your email address, that's okay. Give us a follow on Twitter or on YouTube so you never miss another episode. Before you run, I want to talk about a couple other things. You mentioned equal weight in your portfolio for the best ideas. Equal weight S&P 500 outperforming the market cap weighted. What do you make of that? What's instructive about that to you?
I think part of this is simply a story of the Magnificent Seven pulling back. They've been underperformers this year compared to the S&P 500. But then when you equal weight everything, you can really see just how much of laggards they've been.
Yeah.
I think the 493 is up almost 10% this year, depending on the numbers. I think that's last I checked. And that strength points to broadening, right? Yep. So this rotation story, a lot of investors are talking about right now, I think is very real, and it's definitely not what you see at the end of a bull market.
Right. So another just reason to doubt the bears again.
Yes. And I think if we were seeing a narrowing, then you can start to give a bit more credence to the top heavy debate and whether the bears think we're too concentrated in the mega caps. But we've really seen the opposite in the last few months. So to me, that's actually a really optimistic sign for the broader bull market. And people talk about the health of the bull market.
Yeah.
The broadening out is there. The 493 has been crushing it. And I think it's going higher.
Yeah. And I think the last time we met too, you had done some analysis of the length of the average bull markets. And we still have several hundred days before we even hit the median duration of a bull market.
Yes. And that's very true. And I think so you pair that with the fact that small caps have outperformed large caps, mid caps have also outperformed large caps, and the 493 have beat the Magnificent Seven. Nothing suggests we are in a top heavy market.
Yeah.
And you could still say, well, why is Nvidia 5 trillion market cap? Sure, you're going to have some massive, massive companies in this market, but that doesn't mean that they're the things driving performance, which I think is a differentiator.
That's a good point. And Nvidia is cheap at 5 trillion, right? I mean, it's cheaper than the S&P 500.
Right now, on a forward valuation basis, it is. And that to me is pretty compelling. I own Nvidia. I think it's a great stock. To be fair, I also own the S&P 500 and an index fund, but it's hard for me to think of the most compelling thing that would push me out of the market right now.
Nvidia, I was late to the party there, but I just look at it and go, people are underestimating. I mean, it's like Apple, underestimating Apple, the dominant name in the smartphone and consumer devices. Now that we're talking about the dominant name in AI chips, how does it go wrong at 18, 19 times earnings?
Well, why would you bet against Jensen?
Yeah.
The man.
Yeah.
And he's an amazing founder.
Yeah. All right. So before we run, I want to talk about SK Hynix going public later this week. Got to give you props because you were all on the Korean ETF EWY, right?
Yes.
Because largely of Samsung and SK Hynix, the weighting is in there. It's more than 50% of the ETF. What do you make now? Do you pull some more off the table there to go directly in the IPO now that you can do it on the US exchange?
I probably won't make any personal changes, frankly. I have EWY as a pretty large holding of mine. I've been in that for over a year. It's done very well, almost entirely because of SK Hynix. The fact that we're getting a US IPO for this company, that seems bullish. And again, I'm not a genius by any means, but if you open up the doors for demand to flood in the US market, beyond something other than the South Korean ETF, I think that's a good sign for shareholders. And also, even though I love the South Korea market, I think EWY has been an amazing bet for anyone who's gotten in the last 18 months. It's still a fairly niche product or a niche holding. Like if you and I talk about it, it might feel obvious to us. We're in the market every day, we're investors. But if I flag it to a friend who's not in finance, they won't know about a South Korean ETF. So if it suddenly comes to market in the US, that's going to get a lot more people aware of it. And that's probably good for the stock.
Good marketing, good for the stock. This one's going to come kind of off the wall at you here, but biggest lesson you've learned from investing? Because I look at you as a young guy, super successful, launching multiple businesses, good investor. But what have you learned? I think there's no replacement for putting real money to work in real markets. What's the biggest lesson you learned as an investor?
Your first several years in the market will hopefully you'll lose money because you'll learn how to not go in and out of position so much. Because I think when I first started, I guess I was in college, I would go in and out of positions so much based on, you know, the news or sentiment or like just random vibes I was feeling, or maybe I talked to one person and that one new opinion would dictate my entire portfolio. So now I'm much more disciplined as far as you want to let your positions that you're holding run for a while. And I think you can probably let them run longer than you think you should. Especially in this market. I mean, we haven't really seen a prolonged bear market, frankly, in my lifetime as an investor. You know, the last one was really the great financial crisis. And since then, there's been mini ones, I would say, but nothing super severe. And I think there's a lot of very big picture tailwinds that sort of act as a protective backstop for younger investors. Like the Fed. You think the Fed is going to let a bear market take hold for more than a year? I don't think so.
Yeah, I don't see it.
President Trump, the guy is too bullish. He sees it as a scoreboard for his presidency. He's not going to let the market go down too much.
That's a great point.
So, and these aren't necessarily fundamental factors, but I think if you're a young person trying to get into the market, let your winners run, and then don't go in and out of positions too much like I did. And I lost a lot of money by not being in those positions, but also, you know, you get hit with more taxes the more you go in and out of positions. So really it's you know, you want to let compounding do its thing. And that's a very generic cliche thing to say, but it's so easy when you're getting involved in the market to get overexcited about various positions, and you want to go in and out, try to time the market, tops, bottoms, all that's noise. And if you just buy and hold forever, as long as you believe in the assets, I think you'll do very well.
It's great advice, because I always told people that, like, I've never met a day trader that's been wildly successful. They do well enough to like stay in business. The ones, I'm sure there's some out there, but they're not public about it. They're just privately printing millions and billions and staying off the radar and not trying to sell subscriptions. So
it's a very hard game to be in and out of positions.
It's humbling, and I appreciate your humility and learning it all. I appreciate you joining us again, man.
Thank you, Lou, for having me.